Hello, it's the morning of Brexit. We woke up this morning, we opened our phones, we opened the news app, and we saw that Brexit had won by a margin of 52 to 48 points. Britain has chosen to leave the EU. An awful lot has happened this morning. David Cameron is gone, uh, the pound has crashed, the markets have gone haywire. So I just want to quickly run over some of the implications of this and try to get across to you what I think matters most. Um, so I wrote about Brexit earlier on in the week on Monday, and when I wrote about it, I said that the Leave camp and the Remain camp were talking in different sort of terms. They weren't really meeting each other halfway. The Leave camp was talking in terms of like sovereignty and like whether the EU government even has the right to make rules for British people. Whereas the Remain camp was focused more on the specifics. They're talking about national security. They're talking about the implications for the financial industry or for the farming industry. So they were talking about very concrete specifics, and the Leave camp were talking about like principles. So the Leave camp won. The UK electorate decided that the principles matter most, and that's fine. That's settled now. But the Remain camp's arguments are still there, and they're still relevant. And I think today is time when we need to actually take stock of them and see how much of them were scaremongering, how much of them were real and imminent and serious, and these sorts of questions are starting to reveal themselves, and we're starting to work out the answers. So this morning I just want to go through it. I'm going to ignore the politics. There's a lot you could say about this. I mean, I sort of started a little list of just sort of questions which need to be answered about this. What are the various implications, the economical and political and all that, and it went on for like 20 odd questions, and I just gave up doing that. It wasn't useful. There's too many questions. In fact, it makes more sense to just focus in on a small part of this, which makes it maybe a bit easier to digest. So today I want to focus on the markets, on stocks. I want to see what the stock markets are telling us about what happened. So start off with the FTSE. The FTSE 250 is down by 11.4%. I know that everyone can tell that's a lot. Just for a bit of context, that's the biggest fall in its history since the index was founded in 1984. It's bigger than the Black Monday of 1987. It's bigger than any one-day crash in 2008. It's big. The FTSE 100 is down by 8%. So the FTSE 250 is down by 11.4%. FTSE 100 is down by 8%. The reason for the discrepancy is that the FTSE 250 tends to be more focused on like British companies. It's more it's like a domestic kind of index, more like medium-sized British companies, and medium-sized British companies tend to sell within Britain, whereas a FTSE 100 company might be a giant mining company which sells internationally and is less exposed to the UK market. So therefore, what this is telling you is that the British economy is going to take more of a hit from this than the global economy. That's a given. But it tells you that it's going to take quite a significant hit. Maybe that's not a given. In addition to that, the pound fell by 8% at the last time I checked it, and that's going to have implications for all sorts of companies. I'll get to that. So let's look into the constituents, like what type of industries, what type of companies are winning and losing from the vote. The biggest losers have been, we'll start with the banks. The banks are getting clobbered. Big banks so like RBS and Barclays are down by about 25%. And the reason for this is that basically the City of London, if you imagine it like a big shopping centre, right, just bear with me. A big shopping centre, you'll have anchor tenants, which are your Marks and Spencers and Tesco's, and the big grocery stores which attract customers in. And then around the anchor tenants, you have lots of small different retail stores, and they form a little, what would you call it, a strip. Anyway, so in the City of London, the anchor tenants are the big international sell-side banks. That's Barclays and RBS are British examples of that type of bank, but more than that, there's JP Morgan, there's Citigroup, Goldman, Morgan Stanley. All of these giant international sell-side banks are focused on the city, and then you've got like hedge funds and all the people that they sell to are sort of gathered around them. The reason that these banks choose to set up in the City of London, and the reason that a company like, say, Deutsche Bank, which is a German bank, comes and does a lot of business in the UK is because of something called passporting. Passporting is an EU type of a rule which says that once a company is licensed to do business in one EU country, that means it can sell its products into all European Union countries. And so that means that Deutsche Bank can set up in London, so can Citigroup, Barclays obviously, and then they can sell all across Europe. Now, without passporting, which is what is happening now, no EU, no passporting. Without passporting, that means that all these banks will have to go to each, if they want to stay based in London, they'll have to go around to each separate EU country to which they're selling and get licensed in that country, which is obviously a nightmare. So the implication is that a lot of these banks are going to look abroad. They're going to look into EU countries, maybe move some of their staff to places like Frankfurt, Dublin, Amsterdam, Paris. These sorts of places have been talked about. So yeah, the fact that big UK banking stocks are down by 25% tells you that this is actually a real life concern, and that the market thinks it actually might happen. So what's the knock-on effects of that? London's property sector is obviously booming. Prices are sky high. Prices in London have always been high, but they've just have risen continually even through the crisis, and they haven't let off. And London house builders in particular have been another loser from the Brexit poll. Companies like Redrow are down by 76%. Bovis is down by 58%. And the big house builders such as Taylor Wimpey and Barrett are down by the 20s. That tells me that tells me that this is like maybe a knock-on effect of the banking industry looking elsewhere. There's a lot of money and a lot of bankers in London, and they spend money on London houses. When the bankers leave, London housing will take a hit. Therefore, London and UK house builders will take a hit. That's what we've seen. Okay, looking outside the FTSE, AIM is down by a bit less than the main market. It's down by 4.4%. Looking within that index, the biggest fallers have been, just to take an example, a fintech startup called Proxama, which is a mobile payments startup which is based in London. So fintech is another interesting one. It's a small industry relatively, but it's growing and it's promising, and it really looks like it could take a bad hit as a result of the Brexit poll, the referendum result. Proxama is down by something like 70% at the moment, and that's just it tells the story. Fintech companies are like banks. They require these passporting rules to do their stuff internationally. They sell internationally. Without passporting, they're going to have a lot of trouble being based in London because they're not going to be able to sell into Europe. So they're going to maybe start looking elsewhere. The biggest risers, the biggest gainers from Brexit, the pickings are pretty slim, to be honest. There are a few companies which are up, and those that are up aren't up by a great deal. Rolls-Royce is one example because it's a big exporter. It sells a lot internationally. The fact that sterling has fallen by 8% makes its products 8% more competitive in foreign markets. So that's up by a couple of percent. In addition to that, we've seen some of the gold miners and gold explorers on AIM are up. Gold is up as another consequence of the poll. Now, that's great if you own gold, and fair dues to you, but it's not really great news for the rest of us because gold goes up when returns around the world go down. So that's where I'll end it. Gold is up because returns not around the world are down, not specifically in Britain, and that hints at because of foreign markets as well as British markets are reacting very badly to this. That hints that maybe this result could lead to a bigger kind of problems internationally, whether it could just kick off a recession in the Eurozone or whether it could be the instigator of something bigger. That's a whole different topic, and to be honest, that's speculation on my part. That will become more clear in the coming weeks. and that's where I'll leave it for now.